Hey everyone and welcome back. Today's video is going to be a breakdown and analysis of the company PepsiCo as a long-term investment. So as most of you would be aware, stock analysis is a big part of what we talk about here on the channel. And I think one of the best ways that you can go out and learn how to apply this process to businesses you're interested in is learning about case studies and examples like the one I'm going to talk about in today's video, so that you can see the process that I go through and then apply it to businesses that may be within your circle of competence, businesses that you're interested in investing in, whether that's PepsiCo or any other kind of business. So that's what we're going to go through in today's video. And of course, I cannot possibly squeeze my entire 12-page analysis that I did of this company into a 15-minute video. So I am going to be giving you the headlines of each of the 4 major sections of the analysis process, which, for those who aren't aware, are starting with circle of competence, developing our understanding of the business. We then move into looking for distinct competitive advantages. We assess management in a number of different ways, and then we try and calculate intrinsic valuation. We try and calculate how much money we can get out of this business over the next 10 years and beyond, and therefore put a price on how much we're willing to pay. If you find this video valuable, then a free way that you can support me is just by hitting the like button or leaving a comment sharing your thoughts on PepsiCo or this video down in the comment section below. But for now, let's jump into the first section and start to develop our understanding of this business and talk about some of the key components that make up PepsiCo's business. PepsiCo is a global food and beverage company which was initially incorporated in 1919 and reincorporated in 1986. Over the past 100 years, PepsiCo has built themselves a portfolio of convenient drink and snack food brands, including Gatorade and PepsiCo, which it makes, markets, sells, and distributes all over the globe. In the PepsiCo financial statements, you will notice that they break their business down into 6 reportable segments, 3 of which focus on their food and beverage operations in North America, and the other 3 which combine all of their business brands and break them down into different regions. So taking a look at a pie chart, we can see how their business breaks down into these 6 categories. And you can see that the largest category is their NAB segment, which is North American beverage. This is followed by the blue section at 25% of their revenue, which is FLNA, which is their Frito-Lay North America. This is their snack food brand category in North America. That is followed by the orange section of 17.8%, ESSA, which is the European and Sub-Saharan African section. And then there are smaller segments such as the Asian, Middle Eastern, and North African section, as well as their Quaker Foods North American operations, which are their cereals, rice, and pasta brands in North America. So Pepsi has certainly diversified their business into many different brands over many different regions, but a significant part of their business still comes from the North American beverage segment, which is dominated by brands such as Gatorade and Pepsi Cola, which was the original cola brand that created the company. According to information resources, within the US liquid refreshment beverage category, PepsiCo held 22% of total retail sales compared to Coca-Cola's 20%. However, the Coca-Cola company still has the highest market share for carbonated soft drinks in various markets outside the US, according to PepsiCo's management team. So both Pepsi and Coca-Cola have been competing aggressively over the past 100 years, and both of them have found themselves being able to thrive in the US market as well as internationally, although Coca-Cola has done a slightly better job at the international expansion that their business has experienced. But really, when it comes to competition in this area, it's really going to come down to a combination of all of these different factors that play into building a great drink brand. There's things such as their marketing abilities, how effectively can they advertise their product globally, their pricing, their ability to distribute to locations that are going to get them the most volume sales. There's many different things that play a role into the competitive advantages that these businesses might be able to develop. So let's spend a little bit of time talking about whether PepsiCo has any distinct competitive advantages and whether those advantages are going to allow them to thrive in the future, which is ultimately what we're looking for as long-term investors. So if you've seen my economic moat video where I show you some of the major competitive advantages that we we can immediately identify in these businesses, then you would already know that PepsiCo's major identifiable competitive advantage is their branding. And there's a lot of things that go into making a brand very, very successful. I mentioned a couple of them before. There's marketing, there's brand loyalty, there's the taste of your drink, your ability to distribute it, the price that you're putting on your product. But all of these things combined, it's kind of like a big strategy that a company has. All of those things combined, if done correctly, will create a very strong and sustainable brand. So the next question we need to ask is, how can we make sure that they actually do have a sustainable brand? How do we make sure that we're not buying into a company that has a brand that's strong in the short term and then going to be weak? Or maybe we're buying into a brand that is just straight up weak. Well, one of the best ways we can identify this kind of advantage is by looking at what's called pricing power. So pricing power is the ability of a company to raise their prices while not seeing any substantial dip in the demand for their product. So basically how this would play out is, if PepsiCo has a distinct advantage, then they should be able to consistently increase the price of their drink without customers switching to a different type of cola. And it is that ability to keep your customers buying your products even when it gets more expensive that shows us that they don't care about the price as a primary indicator of their purchase. The primary indicator of their purchase is not the price, it's the buying the actual brand. And that is really the reason why, just to switch this over to Coca-Cola for a little while, but Pepsi also applies here too. But it's really the reason why those two cola brands charge maybe $3 for a drink, whereas you can get a no-named, a home brand, a supermarket branded cola for 50 cents or $1 or something like that. The reason why that occurs is because even though the home brand Coke is cheaper, most people would prefer to buy Coca-Cola or Pepsi. They want the brand and they're willing to pay up for it. And finding that in the financial statements will show us that they do have a distinct competitive advantage. So the graph you're looking at right here is really showing us two things. It's showing us the change in pricing of their beverages in each of the past year. That's shown in red. It's a percentage. And then we have the change in volume, how many units they're selling. So in order to identify a strong competitive advantage here, we would want to see that they're able to raise their prices while not seeing a decline in volume. So you can see that in 2009, they did raise their prices substantially and they saw a decline in the number of units that they sold. However, that was 2009 during the GFC, so that is kind of to be expected. In 2010 and 11, there was no price increases and there was no change to the number of units that they were selling, the volume. In 2013 and 2012 and 2013, they raised their prices, saw no change in volume. 2014, 15, 16, 17, 18, all of those years, they continued to increase their pricing at about 4 to 5% per year. And even through that period, there was times where the volume went up, where even when they raised their prices, they were able to sell more units. So that right there tells me that there's something that has been giving PepsiCo an advantage over the past 10 years, because most drink or food companies cannot raise their prices while seeing an increase in volume. That tells us that there is something compelling people to buy PepsiCo versus switching to some other kind of drink. But that is not the only thing we need to look for when we're looking at competitive advantages, because it's one thing to have an advantage that has worked in the past, and it's another thing to be confident that that advantage is going to be allowing the business to thrive in the future. So for that, we want to look at the 4 key areas of growth, that being sales or revenue, earnings per share, equity, and free cash flow. And by looking at all of these areas, we will be able to see if their growth gives us an indication that they're going to be able to grow quickly in the future. So taking a look at their numbers, you can see that their numbers have been very, very inconsistent. Sales growth has been fairly non-existent, even though they've been doing their price increases. Earnings per share has been growing much quicker because of their reduction of costs and some share repurchases. Equity has actually been on the decline, which is something I don't like to see at all. And cash flows, again, has been very inconsistent. So really, the conclusion that I draw here from PepsiCo is that over the past 100 years, they have built themselves a very strong brand, which has allowed them to maintain their volume over time. But they are at the point in their business, they're a mature business, where we should not expect any substantial growth out of the business in the future. And even over the past 10 years, while they have been able to maintain volume, you can see that their growth has been very inconsistent, and over many periods in some categories, it's actually been negative. So their business is certainly stagnating, and while they might be able to maintain their volume, it's unlikely that they'll be able to raise their volume a substantial amount in the future. The next section of our analysis is to look at management, and as always, we need to look at management in 3 key ways. We need to look at their honesty and transparency to the shareholders. Are their values aligned with ours? We need to look at their ability to invest within the business effectively. And then we also need to look at their ability to manage debt to a low level so that there is a low risk to us as shareholders. But in the interest of time, let's just zoom in on their ability to invest within the business by having a look at the return on invested capital. The return on invested capital for PepsiCo has been strong and consistent, with all years above 10% and many above 15%. The 10-year average ROIC has been just under 16%, and that has decreased to 14% in the 2018 financial year. So this is exactly what we want to see in the return on invested capital, really strong and consistent. But there is actually one more thing that we're looking for. We're looking for strong and consistent return on invested capital at the same time as a management team that is reinvesting a substantial amount of money back into the business to compound those cash flows. And that is something that PepsiCo is lacking here. While they are getting a really high return on invested capital, all of their cash flows that they're getting, for the most part, are being distributed to shareholders. And that's completely fine if that's the kind of business you want to invest in, one that doesn't grow, that's pretty safe, and that is going to pay you out a similar amount of cash each year over the next 10 years. That's fine, but what I'm looking for the most part, are businesses that can have a high return on investment, a 15%, a 20% return on investment, and then put their cash flows back into the business to compound those cash flows for me and to grow the value of the business. So PepsiCo misses out on that side. This doesn't mean, and just to be clear, this doesn't mean that PepsiCo is a bad business to invest in, and it doesn't mean that they're a business that's going to go bankrupt or they're going to slow down. It just means that you can't expect them to grow if they are not reinvesting back into their business substantially, which is exactly what they're not doing. One other thing to mention is that when a business is very, very stable, their cash flows are very, very consistent, and they're paying out most of their cash flows as dividends or share repurchases, the cash flows that you get as an investor for that business are going to be very, very certain. And that is something else that kind of makes it difficult for us to make a high return, because when the cash flows are very, very certain, when you see a brand like PepsiCo probably not going to change the demand for it too much over the next 5 or 10 years, and they're paying out all of their cash flows to the shareholders, then we can pretty accurately estimate what we're going to get back. And as a result, the business is going to attract a higher price and offer a lower return because there's a lot of certainty in the future cash flow. So that's something just to be aware of as to why PepsiCo has attracted such a high price. And speaking of price, let's talk about the value of PepsiCo and see if we can make a substantial return out of this business, looking at conservative growth estimates for PepsiCo. In the 2018 financial year, PepsiCo had cash flow for owners, or free cash flow, of approximately $6 billion. So they produced $6 billion of cash that they could then use to distribute out to shareholders as dividends or share repurchases. Now, the problem with PepsiCo is that the price of the business at the current moment is $200 billion. I almost said 200 million. $200 billion for the whole company. And the way that you should think about this is, if I'm buying the whole company, I'm paying $200 billion, and then I'm getting $6 billion in cash flow return to me each year, plus whatever growth the company can produce, but I would anticipate that the growth is going to be relatively low. And basically what that means is, even if they grew their cash flows, maybe they can produce $100 billion in cash flow for owners over the next 10 years. That would be about 10 billion per year, and they're currently doing 6 billion. But that would mean you get back 100 billion, but you've paid 200 billion. So you didn't even get your money back over a 10-year period. And this is the problem with PepsiCo, is the price that it has attracted because it's a safe business. And because we're getting closer to a recession, this is the kind of business that people flood towards when everyone's panicking, because they know that the cash flows aren't going to fall. But this is a classic mistake that many people make, is they look at the business, but they don't look at the price. They think that if I just buy a great business, it doesn't matter what price it is. It doesn't matter what I pay for it. It's a great business. It will make me a high return. And that is completely flawed logic, because you have to outlay money for a certain amount you're going to get back in the future, which means there is a limited amount that you should be willing to pay for any company, including PepsiCo. And at the moment, it's just the fact that everyone is willing to overpay for PepsiCo because it's relatively safe, but I would anticipate that the future return out of PepsiCo from this point onward, is probably going to be pretty not that great. I would say it's probably going to be less than a 5% compounded return. So I hope you guys enjoyed today's video, and if you did, as I said at the beginning, I would very much appreciate it if you could leave a like or let me know your thoughts down in the comment section below. But for now guys, I will see you in the next video.